Very good morning, friends. I hope you're all doing good. And of course, as I always keep saying, that I believe that you've done your cumulative revisions on financial instruments. So we have come a long way in terms of financial instruments covered Index 32 quite initially. And then our focus turned on to Index 109. And we have completed a journey on the accounting of financial assets initially and subsequently. And we've also done a total of, I would say, 5 special issues relating to the concept of financial assets. I mean, I'm not drawing a mind map on that particular 5 issues that I think I've already done in the last session with you. But just to quickly remind you, what are the special issues relating to financial assets? I'd given you, first of all, that you need to understand that if there is a transaction price and a fair value difference, how is the transaction price and a fair value difference accounted for? Then we also saw the case of, in this connection only, that if there is, let's say, a prepaid, let's say a concession loan resulting in a prepaid staff cost, how do you tackle a case of a prepayment in case of a concession loan? Quite linked to the first issue. Then we understood the concept of a loan payable on demand, recoverable on demand between the parent and subsidiary, which also indirectly stems out of the first issue, where there is a holding subsidiary relationship, where the concept of fair value does not apply, the concept of interest receivable does not apply. And then I gave you another agendas also related to the financial assets, but these are typically the main issues related to the concept. And of course, we covered the concept of processing fee, which is pretty simple, a little different from the transaction cost, because transaction cost is added to the financial assets, but processing fee is reduced from the financial asset. Now, when we come to the concept of financial liability also, you need to be clear in terms of the accounting treatment of a TC as well as a processing fee. No worry, we'll pen that down when it comes to making the chart on the financial liabilities as well. Anyway, the issue as far as financial assets are concerned is taken care. Now our focus is on the financial liabilities. We're focusing in terms of the accounting of financial liabilities, for which I made some background. I gave you some inputs as well, but I'll just like to quickly make a mind map to connect the dots. I know some of the financial liabilities may not be very clear, because I think we still need to make some work through on them. But I think to kick off the concept, I'm just going to make a small mind map on the classification of financial liabilities, what we decided, and also to add another element as well. And that was regarding the financial liabilities designated at FPTPL, where I did not make a mention regarding the changes taken in OCI as well as in P&L. So let's make a mind map and then start working on the financial liabilities accounting. So I'm just making a mind map on the financial liabilities to connect the dots before our discussion starts off today. So in terms of the financial liabilities accounting, initially as well as subsequently, so we first of all decided, just like financial assets, so we said whenever you're looking at accounting, that is measurement, your mind should start working on initial measurement, and your mind should start working on the subsequent measurement. So we're looking at, just like financial assets, the financial liabilities accounted initially at what value and subsequently accounted at what value. So we decided that financial liabilities, just like the financial assets, are going to be captured at a fair value. But then there are 2 exceptions, exactly the way there are exceptions in terms of FA. And the 2 exceptions are, one is the trades payable, which is going to be recorded at a TP, that is a transaction price. And the other one is the loans which are payable on demand. I think we have seen that already in holding and subsidiary, when the loans recoverable as well as payable in terms of demand. Then comes the concept of subsequent accounting. And when it comes to a subsequent accounting, then we know that there are various categories in which the financial liabilities are broadly divided. So we need to consider that there are four broad categories in which the financial liabilities are segregated. Well, I guess if somebody were to say, put this in a very simple terms, then I would say financial liabilities are broadly of two categories. One is AC and one is FPTPL, and I will say that's the end of it. But then technically speaking, when you get on to the concept of classification, effectively there are total four categories of financial liabilities considering the interaction of 109 with the other standards as well. And in this case, the first category is amortized cost, which I would say is more or less a default category. Unless there is anything to the contrary which tells me anything, I would say the default category in terms of financial liabilities is AC. And trust me, the financial liability ledger is going to be made exactly the way you remember a liability account, the liability component of a CFI is drafted, exactly the same. So that means the way the financial liability element of a CFI was accounted, that was basically an amortized cost approach. 100% replica of the same concept would trigger. The next one is FVTPL, that's fair value through profit and loss, in which we said there are basically two subcategories. And the two subcategories is, one is if it is held for trading, something like derivative, for example. So if you've got liabilities which are supposed to be derivative in nature, then in those particular cases, all derivative financial assets and liability, I'm putting it assets also, because we've already seen in terms of assets, derivative investments, and you can say derivative liabilities, all taken at FPTPL, held for trading. And then we said there is a contingent consideration which arises in terms of Ind AS 103. When you're going to learn the concept of business combination, and that would trigger the calculation of a purchase consideration. So this is what we're going to tackle later, not at this stage. So don't get worried. Just remember that the contingent consideration is a part of the FPT approach. That's it. Now, what is this contingent consideration? How it is accounted and all that we are going to learn in terms of Ind AS 103. The next agenda which comes into account is what is called designated. It is what is called designated at FPTPL. That means it is not satisfying the criteria of FPTPL per se. Let's say, for example, the financial liability is getting accounted. The financial liability is getting accounted at AC, but we decide that this is going to reduce or eliminate accounting mismatch. We did one of the very, earlier example of fixed rate debentures financed by, the fixed rate assets financed by fixed rate debenture, in which I gave you some combinations that why would a company, designate a financial asset or designate a financial liability at FPTPL to avoid mismatch. Because if the financial assets and liabilities are taken at a fair value, the gain on the asset, the loss on the liability, or you can say the loss on the asset and the gain on the liability gives you an offsetting advantage. So companies may consciously decide to designate the measurement of financial liabilities at FPTPL, and this is in order to reduce. This is, you can say, to decrease what is called the accounting mismatch. So we've got that flavor earlier, how the accounting mismatch results in designation. But then we need to understand the broad difference between FPTPL and designated at FPTPL. So we say that if it is FPTPL, the changes in terms of fair value is going to be captured in the P&L. But if it is designated at FPTPL, then the changes in the fair value is going to be segregated in terms of two elements. So I think the treatment in terms of FPTPL and the treatment of designated FPTPL differs, because in this case the fair value changes gets captured in the P&L, and there the changes due to own credit risk. I said we'll not get into the details of how do you split that, but you need to know that if there are fair value changes due to own credit risk, it is taken in the other comprehensive income, and for the balancing figure there is any other changes, it is taken in the P&L. So therefore, we make a distinction between the liabilities designated at FPTPL and liabilities which are per se, of course, held for trading or a contingent consideration. And then we also talked about the special issues of financial liabilities as well, and the special cases which we did in terms of financial liabilities. Typically, you can say this falls into two categories. One is the financial guarantee. One is the financial guarantee that if you are giving a financial guarantee, say for example, your subsidiary has taken a bank loan and you as a parent company give a financial guarantee to the bankers for the loans taken by the subsidiary, it becomes a case of financial liability and it's going to be captured in the books of accounts. It's not a contingent liability. It's going to be reflected as an actual liability in the books of accounts. And we also saw this in another case is financial liabilities because the financial assets cannot be derecognized. When the financial assets are not eligible for derecognition, where I gave an example of a bill of exchange, I said it could result in creating a financial liability. Now, here I give you the chain of thought. Let me just quickly connect the dots and tell you how my discussion is going to proceed today. So we can clearly see the lot of permutations, combinations coming in. So we will see first of all how the accounting of financial liabilities at AC is done. How the accounting of financial liabilities at FPTPL is done. We're not looking at accounting of designated FPTPL because in that case, I don't think so the examiner could ask you in terms of segregating the fair value changes due to own credit risk and which is due to any of the changes. And I think if he gives you the split between the two, then I think life is jingalala. Because in that particular case, he's already given you the data. We just need to capture that, okay, this change is going to go in the OCI and this change is going to go into the P&L. So that's not a big deal. So we'll not get into how the split between the two components are done. That can be quite a complicated affair. And neither it's been, discussed at length in the study. So I think I'm not getting into that part. Then in terms of this, we'll discuss financial guarantees. This we'll discuss later. It's not that we're not going to discuss this, but this is what we're going to discuss later on when we come to the concept of derecognition. So which means in terms of financial liabilities, what you need to understand is typically three cases. How the financial liabilities AC accounted, how the financial liabilities FPTPL accounted, and how would the financial guarantee get accounted. So once you're done with these three cases, I think we're done with the concept of financial liabilities. Thereafter, I have got two interesting questions which I said mixing Ind AS 109 with Ind AS 21. So one question on a financial asset, one question on a financial liability, where we're going to see the blend of Ind AS 21 foreign exchange with reference to Ind AS 109. That will complete the journey in terms of financial assets liability completely. And then we've got three special agendas of discussion. Derecognition of financial assets and liability is one, impairment is another, hedging is another, and of course, embedded derivatives is another. So four more special issues after that. Once those four special issues are done, then the standard is done. This is not the agenda for the day. This is the agenda for the remaining sessions on the financial instruments as well. But once financial liabilities are done, we have got four special issues to be discussed in the standard: impairment, then you can say hedging, then there is embedded derivatives and derecognition of financial assets and financial liabilities. Okay, so I think that gives us a quick mind map on the financial liability concept. Let's now begin with the accounting of these three cases. So I'm doing three cases. In terms of FA, I did 5 cases. In terms of FL, I'm doing 3 cases. AC, FPTPL, financial guarantee. And of course, let me also tell you, this financial guarantee is not accounted at FPTPL. It's accounted at something different. We'll see what is the difference once we come to the inputs. So far, so good. Let's, I think, now proceed with the question in the study material. I'm carrying some own additional questions also today, but I think first we'll just go to the questions in the study mat and have a look at this. I'll also revisit on the concept of giving you the insights on the elimination or the reduction of accounting mismatch, because we did that illustration when we did financial assets, but I said I'll come back to this agenda once we're done with financial liability. So I'll come back to that illustration number 30, which we've already done earlier. Let me, I think, first take you to a very simple question, identifying. First, we're going to look at identifying what is the category of financial liability. So first, we're going to look at the category of financial liability and then proceed further. Okay, so let me, I guess, come on to the agenda on the first example, that is illustration number 29. This is the unit number 2. This is the unit number 2 of the study material. I hope, friends, it is visible. I hope you can see this clearly, right? Okay, so I think let's come to the illustration number 29, where we're deciding the classification. We're just deciding the classification. So the focus right now is only looking at the classification of a financial liability. Let's have a look. It says a company purchases the raw material from a vendor at a fixed price 1,000 per ton of steel. The payment terms are 45 days credit period, after which interest at 18% shall be charged. How would you classify this in the books of the company? Well, I think in this particular case, we don't see that it's held for trading. I'm not given any data where it is designated at FPTPL as well. So I don't see that it's designated. I don't see it's held for trading. So I think the default category AC would undoubtedly apply. So it says in the above case, the creditors shall be carried at AC, that's amortized cost. That is fair value of the amount payable upon the initial recognition plus the interest if the payment is delayed. Here the fair value on the initial recognition shall be the price per ton. The transaction price will be taken as a fair value. Reason, I already said that there are two cases when the initial recognition is done at a transaction price, trades payable, as well as a loan which is payable on demand. So it says clearly the transaction price is representative of the fair value. So this is a clear-cut case where number one, no concept of fair value. The TP represents the fair value exception, and it's by default accounting at AC. Simple, done. Okay. Now I think let's go on to the next one. I think we had another illustration as well, where we're also given, I guess, maybe missed that illustration, I think. There is another illustration which was there in the study mat, and that was on the concept of a derivative. Anyway, so I think before we go further, now let me just quickly take a little recap on the elimination and reduction in terms of accounting mismatch. Then we can go on to the AC concept. So another illustration 30, which we've seen earlier, but I think now you will be able to get some more detailed insight, because now we are a little more clear in terms of categories of FA and FL. So revisiting illustration 30 once again. It says an entity is about to purchase a fixed rate assets that will be financed by, highlighted, financed by fixed rate debenture. Let me ask you, first of all, a very simple question. Are the two assets and liabilities related to each other? It says the company made an investment. It says in fixed rate assets, which is financed by fixed rate debenture. Is the asset and the debenture, the liability, are they connected with each other? What do you say? I would say yes. And I think before you start designating any financial asset or liability, the relationship between the asset and liability needs to be established. The money which is invested was financed by a fixed rate debenture. So there is definitely a relationship between the asset and liability. This is one of the preconditions before you could designate a financial asset or liability at FPTPL. Let's read further. Both the financial assets and liabilities are subject to the same interest rate risk that gives opposite changes in the fair value. Now, that's another precondition, that they're giving you opposite changes in fair value. That means if there is a fair value increase in asset gain, it'll lead to a fair value gain. So which means fair values both goes up. Asset gives you a gain, liability gives you a loss, or asset gives you a loss and liability gives you a gain. So it's going to give you opposite changes in fair value. Opposite changes in fair value does not mean opposite direction. Opposite changes in fair value does not mean opposite direction. Opposite changes mean a gain on the asset is a loss on the liability. A loss on the asset is a gain on the liability. That's what we are saying, opposite. That tends to offset each other. Gain loss will get offset. Provide your comments. I'm pretty confident this time as we revisit this illustration, you will be able to connect some more dots. You will be able to understand this question clearly. Tell me yes or no. Are you able to now understand the question in a little better intensity? When it says fixed rate asset financed by fixed rate debenture relationship, and then it says opposite changes offsetting each other. So I think the two parameters are very clear. The asset liability related, one. And then there are opposite changes which will give an offsetting advantage too. And that gives a grounding work in terms of classifying the financial assets liability both at FPTPL. Now let's read further. I think nobody said yes that we understood the question better. I thought I'll get some vouching done on that. Too technical question in the morning. That's why we're revisiting, because now we know financial assets and liability, and I think we can understand the concept of elimination, reduction in the accounting mismatch a little better. No yeses in the morning since. Too bad a question to ask in the morning, I guess. Okay, let's, I think, proceed and let's read it further. It says the fixed rate assets provide a contractual cash flows, and based on the business model of the entity, they may be classified at AC if the entity is collecting the contractual cash flows, or FPTOCI if the entity manages through collections and sale. Did you notice something? He did not say that the financial asset is taken at FPTPL. He's only taking two broad categories. Undoubtedly, it is a debt investments. I'll pen that down as well after I'm done with this. I'll give you a better picture of the state. So it talks about that the fixed rate assets are definitely going to be a debt investment. And in terms of debt investments, it'll definitely pass the CCFC SPPI test. And considering the business model, either it's taken at AC or it is taken at FPT OCI R. Then he says, in the absence of a fair value option, the entity can classify the fixed rate assets at FPT OCI with the gains and losses and changes in the fair value taken in the other comprehensive income. And the fixed rate debentures at AC. It says the fixed rate debentures is taken at AC. Now, fixed rate debentures would, of course, not be a case of FPTPL. The fixed rate debentures would, of course, not be a case of FPTPL. So he says that this is, of course, taken at AC. And then it says, however, reporting both the assets and liabilities at FPTPL corrects the measurement inconsistency and produces more relevant information. Hence, it would be appropriate to classify the entire group of fixed rate assets and fixed rate debentures at FPTPL. Let me, I think, explain this a little more detail out here. Now, since we know the concept very clearly, let's, I think, start working on this on a permutation combination where you can even present your answer, in a very chronological tabular form. Let's, I think, analyze this further. So I'm just going to add and give you some more insights on this. So we are working on, you can say, a special issue. We're working on the concept of a special issue, and that is decreasing accounting mismatch. reducing, or you can say elimination of the accounting mismatch. This is the special issue in terms of financial liability. I'm putting it as a special issue. So I would say there are two, three things which you need to keep in mind as special issues. The special issue number one is the elimination or reduction of accounting mismatch. The second is the TC treatment. The third is the processing fee treatment. We'll talk of each one of those issues one by one. So this is my special issue number one. So in the end, after my entire discussions, I'm going to make a mind map again, giving you the flow of thoughts, the chain of thoughts which you need to apply in terms of financial liabilities as well. Okay. Now let's consider the financial assets and the financial liabilities. Now please hear this very carefully. You'll get a complete clarity of thought. Financial assets and financial liability. Since they are talking in terms of, please mind the words carefully, since they are talking in terms of designating the financial assets and liabilities at FPTPL, so the question of classifying the financial assets at FPTPL is being thrown out. And in any case, let me tell you one thing very clear. In one particular parameter, what you need to consider that there is a fixed rate. So what I'm given in the input is that there is a fixed rate assets. There is a fixed rate assets. Now, the logical presumption is that if it is supposed to be a fixed rate assets, it has to be a debt investment. That is one. So your mind should think in terms of that if it is a fixed rate asset, you need to tell the examiner that it is supposed to be a debt investments, cannot be equity investments. And logically, if it is a fixed rate assets, we are saying on a very safe side, because we are explaining the combinations of designating at FPTPL, so we cannot assume that it is originally decided at FPTPL, because you're explaining that it is going to be designated at FPTPL. So we say, depending upon the business model, either it gets measured at AC or it gets measured at FPT OCI, that is R. That becomes a logical presumption. That becomes a logical presumption that based on the concept that it is a debt investments, which is based on CCFC SPPI test, and since we want to consider designating it at FPTPL, we're not working at FPTPL classification. Either it gets classified at AC or FPT OCI, depending upon the business model. Similarly, I'm also given that there is a fixed rate debentures. The next is what we're given, that there is a fixed rate debentures. And when you say it is a fixed rate debenture, undoubtedly, it cannot be equity. It is going to be a financial liability for sure. So this is going to be a financial liability. And in terms of fixed rate, it's not held for trading. And therefore, I think on the safe side, we can say it is going to be taken at AC, the default category. So first you explain the examiner that the fixed rate assets would get classified under these two categories typically. The fixed rate debentures will get classified under AC, that is typically. Now, in this particular case, if you notice, as far as the fair value changes are concerned, not captured. Here the fair value changes are captured in the OCI, and here the fair value changes are again not captured. So we tell the examiner carefully that fair value changes not captured, captured in the OCI, and it is again not captured. Now, the good advantage is, typically if you're falling in this category, and if you're falling in this category, now what the company can do in this particular case? The fair value changes goes in the OCI and no fair value changes are captured, which means it's a one-sided accounting. It's a one-sided accounting where the changes in the fair value of the financial asset is hitting the P&L. Either it's a gain or a loss. So it is one-sided impact. It is hitting the other comprehensive income. So if the company knows that these fixed rate assets are financed by, so we can say if they are financed by the fixed rate debentures, It gives you a connect between the financial assets and the financial liability. Condition one. It leads to a connection between the financial asset and liability. So this is like the condition number one. And the second is, if you're going to capture the fair value changes, if you designate this at FPTPL, so we decide that let's designate this in terms of FPTPL. So you can say what is going to happen in this particular case. Here, if you get a fair value gain, here you're going to get a fair value loss. Here, if you get a fair value loss, you're going to get a fair value gain in this particular case because they're giving opposite changes. So the second parameter which we're looking at is that they are giving opposite changes. They are giving you opposite changes. So two conditions which can be evaluated. First of all, getting the connect between the asset and liability, that is one. And second is opposite changes, where the fair value gains and losses in this particular case will give you an offsetting advantage. They will offset each other. So once you're able to establish the two inputs, getting the link between the asset and liability, that is one. And the second is in terms of the fair value gains and losses giving an offsetting advantage to you, designating an FPTPL would make sense. So you then tell the examiner that this designation is going to result in elimination or reduction in the accounting mismatch. I hope, friends, I stand now very clear in terms of my thought process. Sir, is the fair value gain causing a fair value loss or the independent events? Well, we are considering that fair value of both the assets and liabilities goes up because they are moving in the same direction. If the fair value of the asset goes up, gain. If the fair value of the liability goes up, loss. So when we are considering this particular chart, we are of course saying that the fair value in this case increases. That is the first one. And we are saying the fair value decreases. If the fair value increases, asset, you get a gain. Fair value increases, liability, you get a loss. Fair value goes down, asset, I get a loss. Liability, I get a gain. So once the gain and losses both are put in the P&L, that offsetting advantage is going to reduce the accounting mismatch for the company. So the company needs to prove in two conditions for designation. One is that the asset liability should have a connection. Like it said, the fixed rate debentures, the fixed rate assets financed by fixed rate debenture connection. And the second is that you should be able to prove that since they are going to give you gain and losses, because of the fair value goes up, the gain and losses. So by designating the assets and liabilities at FPTPL, in this case, you're designating the financial asset also at FPTPL, and you're designating the financial asset also at a FPTPL, so that the fair value changes both enter the P&L, give you an offsetting advantage, and the company eliminates the mismatch. I hope, friends, now I am able to give complete clarity on illustration 30. We revisited on this illustration, and I think you got this clear. Wonderful indeed. Okay, so this is done. The special issue number one is done. I think let me just give you another two special issues right at the moment. Since we're discussing the special issues, I think let's make a complete chain of the special issues and then go to the AC concept. Okay. So let me, I guess, work upon this agenda as well. So I'm looking at the special issue number two. I'm looking at the special issue number two, and that is regarding transaction cost. That is regarding the concept of a TC. So I think since the special issue discussions is on, let's, I think, pen this down out here. Okay, so I think this takes care of the first agenda for me, and that's great. Now, I would say typically, when I'm looking at a TC, either I'm looking at financial liabilities at AC or FPTPL. And trust me, the concept of TC is same as financial assets, but. In terms of assets, you added the TC. In terms of liability, it'll get reduced from TC. Now, many people ask me, so why? Because that question did not come up in terms of financial assets, but now it's going to come in financial liabilities. The logic is simple. When you raise money, what is the entry? Bank debit, FL credit. Please mind this carefully. Bank debit, FL credit. And when you pay a TC, it's going to be FL debit. It's going to be FL debit, bank credit. So when you raise the money, it's FL credit. When you pay the TC, FL debit. So that means it's going to get net off in this case. So in terms of AC, the initial recognition will be at fair value minus the TC. So this is, you can say, at the time of initial recognition. At the time of initial recognition, the financial liabilities at AC will be at a fair value minus the TC. But in terms of FTTPL, it is fair value. TC is immediately expense to P&L. TC is supposed to be immediately expense to the profit and loss account itself, just like financial assets at FTTPL. So that is the special issue number 2. Let's also discuss the special issue number 3. Let's also do the discussion on the special issue number 3, and that is on the processing fee. So all the special issues will get taken care in one go. Now, in terms of the processing fee, let me again tell you, you will see that this concept would apply to AC category. Loans are the places where the processing fees is charged by the bankers. And I think this is not going to apply in terms of FPTPL because loans will not be called as FPTPL by the bankers. So in this particular case, you can say if a company has taken a loan, then I think this loan involves a processing fee, and this should be definitely measured at AC. Any guess? What are you going to do with the processing fee? Let's say I have taken a loan from the bank and I pay a processing fee. Then in that particular case, what is happening? I'm getting some money and I'm paying a processing fee. So is this going to be added or reduced? Even in terms of financial asset, it was getting reduced. And even in terms of financial liability, trust me, it's going to get reduced. So the treatment of processing fee from the FAFL point of view is the same. I hope you got the connect. That's right. So what we're going to do in this case, we'll take the fair value minus the processing fee at the time of initial recognition. So when you consider the initial recognition in this case, it is going to be fair value minus the processing fee. So my mind is now working very good. You should be clear on the concept of TC for a CFI, TC for a FA, TC for a FL, processing fee for a FA, and processing fee for an FL. What is to be done, plus, minus, all that should be very clear in the minds. Okay, so I think the 3 issues are done. Now we are ready to go to the complete accounting of financial liability. So just to connect the dots, we have covered the concept of conceptual understanding of how the financial liabilities are accounted. Giving you the 3 special cases, the treatment of TC, the treatment of processing fee, and also the concept of elimination or reducing the concept of accounting mismatch. Now we are ready in terms of looking at a larger picture in terms of financial liability accounting. So let's go back on the study material and let's have a look at now illustration number 31. So let's have a look at the illustration number 31. Wonderful illustration. I hope that is visible. You can see that, I guess, visibly clear, I guess. Good to go. Okay, let me now read this. This is my case number 1. This is my case number 1. So as I said, I'm doing 3 cases now with you. One is a case of AC, one is a case of FPTPL, and one is a case of financial guarantee. We'll see that. Okay, let's, I think, have a look. Or maybe I can just add another interesting illustration. I have just added another small little question from my side as well. Yes, this is a good one indeed. Why it is a good one, I'll tell you. So let me just, I think, take a little walkthrough in terms of the question number 3. This gets interesting because of the presence of the processing fee as well. Okay, similar kind of illustration there in the study mat as well. Let's, I think, first have a look at this particular part. Okay, now I am given the informations in this particular case. It says A Limited made a borrowing from KBC Bank for 10,000 at a fixed interest of 12% per annum. There is a loan processing fee additionally paid, and the loan is payable in 4 half-yearly installments, 2,500 each. Wow. The loan is payable in 4 half-yearly installments. That means I am going to repay the loan principally in 4 equal installments, 2,500 each. He's already given you the principal repayment is in 4 equal installments. The loan amount is given, the loan period is 2 years, and it says the repayment of the loan starts on 30th September X1, which is paid half yearly. Wow. The principal is paid in 6 monthly, and the interest is paid quarterly. Now, that can test your knowledge on your strategic financial management concepts in terms of organizing. I'll ask you very shortly. The installment is given, the interest is given, and the interest is charged on a quarterly, already stated. And there is an upfront fee. That upfront fees is nothing but it is supposed to be the processing fee. How would the loan be accounted in the books of A Limited, which is borrowed this money? Let me now make another statement, and I think you'll easily vouch me for that statement. I think I have now added in my list a total of 4 items, whether it is FA or FL. Let me make a strong statement and you can vouch me. Can I see if I'm looking at FA at AC or FL at AC, and I look at 4 inputs in the question, any one of them? Discount, premium, TC, processing fee. It should trigger the concept of EIR. Agreed. My mind is more working on the element that if you're accounting at FA at AC or you're accounting at FL at AC, 4 factors, any one present: discount, premium, TC, processing fee. It will trigger the need in terms of calculating the EIR. And I think that's rightly agreed. Wonderful indeed. That's great. So the moral of the story. Okay, I got a question as well. Sir, in this case, there will be change in the fair value now due to quarterly interest payment and half-yearly principal payment? No. Since it is a case of AC, we are not accounting any fair value changes in this case. Initial recognition is at a fair value, but if it is accounted subsequently at AC, no fair value change is captured. The fair value changes are captured in terms of FPTPL or when it is designated at FPTPL. We're going to make a combined chart on the financial liabilities, exactly we did for financial assets after all the 3 cases are done. How do you account for the changes in the fair value? Is the EIR concept applicable, etc., etc.? Right? I hope I stand clear on that. Okay. So we can very clearly see that there is a processing fee, and therefore this triggers the need to calculate the effective interest rate. Now, this is going to be quite impressive, if you have to calculate the effective interest rate. Because now, if you start looking at the cash inflows and outflow, the inflows are not at the end of each year. I guess you understand the implication. The inflows in this particular case is supposed to be, quarterly basis is the interest and half yearly is the principal. So you've got inflow. Because when you're going to look at the calculation of the internal rate of return or the effective interest rate, you're going to see that, okay, today I made a loan. So my cash outflow to the extent of loan is 10,000 and I get the processing fee. So my outflow becomes 9,500 and the inflows over the next 2 years, quarterly there is interest, 6 monthly there is principal, and that becomes a challenge in terms of calculating EIR. I think I'm not getting into the strategic financial management in this case. All I'll do, I'll just organize the inflow, outflow, tell you the data points, And then you can, get your internal rate of return on this case as well. Because getting the IRR in those cases becomes very simple when the inflows are on an annual basis. But when the inflows are quarterly as well as on a half yearly basis, getting the internal rate of return becomes a little complicated, because in those cases, the discounting factor, you need a discounting factor in the middle of the year. You need a discounting factor at the end of each quarter. I think I'm not getting into that exercise. But let's, I think, solve this out. Question number 3. So I'm just going to first of all organize the data before we make a ledger account. I'm going to first just organize and get how would the EIR get arranged. So we can say the presence of the processing fee will trigger the calculation of EIR in this case. Since it is a case of a processing fee, you need to calculate the effective interest rate. So let's organize the inputs in this case. So I'm just going to organize the input in this case regarding the inflows and the outflows. So we can say there is a cash outflow at time 0. The cash outflow at time 0, 10,000 is the loan and the processing fee is 500. So if you look at the point of view of the banker, if you look at things from the point of view of the banker, we can say he gave a loan of 10,000, he got a processing fee that is net 500. And if you look at the cash inflows year 1, and you've got year 2, and I think in this particular case, what we need to consider is the data points, which is, you can say at the end of quarter 1, at the end of quarter 2, at the end of quarter 3, and quarter 4. So let's, I think, reorganize quarter 1, quarter 2, quarter 3, and quarter 4. Similarly, quarter 1, quarter 2, quarter 3, as well as quarter number 4. So as the information goes in the question, the interest is on a quarterly basis. So you've got an inflow of interest every quarter. And you've got the principal element, which is there at the end of every 6 months. So interest becomes an inflow every quarter, and the principal becomes an inflow at the end of each 6 months. Wow. I've just organized the data points where you look at the outflows and the inflows, and then based on the outflow inflows, you are going to calculate the internal rate of return, which is the effective interest rate. So I think I'm already going to give you, once you calculate all this, I'm just going to give you the data point directly. The internal rate of return is going to be 16.6%. I am not going to give you how the calculation of this EIR is going to take place, because that is a SFM decision. I've just given you the data points, how you're going to organize things, and then you can keep your hit and trial and calculate EIR. So what happens in the exam if the examiner does not give us this EIR? Generally, it doesn't happen that way. I think a similar kind of questions is given in the study mat, and the organization of this point is given. Though technically you should know, if you know financial management, you know that how the internal rate of return is going to be organized in this case. So once the data is connected, you can keep working on that. Okay. So one thing which we've done in this case is the EIR calculation. So let me just now remind you, this is my case number 1. This is financial liabilities accounted at AC. So this is my case number 1, financial liabilities accounted at AC. I am now also going to show you a ledger account for at least year 1. I'm going to show you a ledger account at least for year 1, so we are absolutely connected in case 1. Let's have a look now on the financial liability ledger. Now we need to be very careful on the data, because in this particular case, when you're looking at the ledger account, you need to see that interest is moving quarterly and the principal is moving 6 monthly. So we need to be very careful when the entries are to be done and whence the ledger account is closed. So in terms of financial liability, so we can say the entry becomes bank debit. Initial recognition is 10,000. minus the processing fee, and that works out at 9,500. So this is the amount at which it is recorded initially. So in this case, there will be change. Okay, I think that was answered fair value. Okay, now let's go carefully with the calculations of the interest. So this is done on 1st April. Now we need to go with the entries on the end of the first quarter, 30th June. 30th June, we need to make the interest calculations due. So finance charge. And you're going to consider the finance charge on this 9,500 at the rate of 16.6%. And if I rightly remember, the calculations in this case is done on the basis of days. Oh my God. But I think you can do it for 3 months. But technically speaking, they've done it on the basis of days. So I think let's take the days. April, May, June. Can you give me the number of days in this case? So we can get the finance charge in terms of days. April, May, and June. I think it's coming to a total of 91, or is it 90? So April is going to be considered as 29, and then it's 30 days, and then it's going to be another 30 plus this. I think it comes to a total of 91 days. That's right. So let's consider 91 days interest, 9,500, 16.6% for 91 days. That comes to approximately 393. That comes to 393. That is approximately. Okay, now we need to be careful on this. Did we pay the interest on this date? Yes. On 30th June, we paid the interest as well, because interest is paid on a quarterly basis, and the interest will be on 10,000. And what was the contracted interest rate? I think it was 12%. And this is going to be paid quarterly. So I think we can directly take it as 3 by 12. So here we're considering the effective days. Here I'm taking 3 months. So on 10,000, 12% for 3 months, that works at 300. So this is the input at the end of the quarter. Interest made due for a period of days using EIR, and then the money is paid on a quarterly. Now let me ask you something further. Am I going to calculate the interest on 30th June? On 30th June, sorry, this is not 30th June, this is 30th June. Okay, now my question is, are you going to calculate the interest on 30th September on the net balance in the ledger? When I'm going to go another 3 months quarter, so can I say this is the outstanding balance? So on 30th September, when you're going to calculate the finance charge, you need to consider what is the outstanding balance at this stage. Let's see the outstanding balance, 9,500, 393 minus 300. So this is 9,593 at the rate of 16.6%. How many days will there be in the second quarter? I guess it's July, August, and September. I think it comes to 92 days in this particular case. Let's take the calculations of the interest in this case. That's right, 92. So 9,593, 16.6 for 92 days. That comes to 401 approximately. And now we are going to make payments in this case. And the payments are 2 payments now. So on 30th September, when you make a payment in this case, there are 2 payments. One is the interest of 300 and one is the principal repayment, that is 2,500. So that makes it a total payment. We cannot close the ledger account at this stage because we're just 6 months away. We're just, done accounting for 6 months from the beginning till the middle of the year. Another 2 quarters. Another 2 quarters. So now let's go on to 31st December. Again, we need to make the calculations of finance charge. So the question which comes again into the mind, when you go to calculate the interest on December, are you now going to consider the effective balance at this stage? Yes or no? When you go to do the calculations on December, are you going to consider what is the outstanding balance in the ledger on 31st December, and on that outstanding balance, you're going to consider interest? Yes. So let's see, this is 9,500, 393, 401, and that's to the extent of, I think, coming to 7194. 7194 at the rate of 16.6%. And this is going to be how many days? I guess October, November, and December. I think it's coming to 92 days again. So we'll take the interest on the outstanding balance to the extent of 92 days. 7194, 16.6%, 92 days. I think it's coming to around 301 approximately. Wow. So now we pay on 31st December, that is quarter ending, we need to pay the interest. How much interest are you going to pay now? Can I say 1/4 of the principal is gone? So now the interest is on the remaining principal 7,500, or you can simply take 1/4 reduction on this. Or if you want, you can work it out. 7,500, we take a 12% interest for a period of 1/4. So on the outstanding amount, 7,500 at the rate of 12%, that works out at 225. Or you can take 300 minus 1/4, that is 75. So basically you get the interest on the outstanding amount. Wonderful. Okay, so this is done. Now we need to go further once again, and let's have a look now once again on the other agenda. So now we go on 31st March. So let's see what is the outstanding balance at this particular stage. So let's see what is the outstanding balance in this ledger. So it can be really fun, In this case, since we are given quarterly and 6-monthly payments, the calculation of EIR has got its own challenges, and then making a ledger account has got its own challenges as well. Okay, so let's now consider the calculation of the finance charge on 31st March on the outstanding balance. So 9,500, 393, 401, 301. And this works out, I guess, at 95, 393, 401, 301. I think this is 7270. Interest at the rate of 16.6%. And how many days are you going to consider for January, February, March? So January, February, and March, that makes it 90 days, 28 days in February. And let's say 7270 into 16.6 for 90 days. This is coming to almost 298 approximately. And then finally, we make the payment on 31st March, that is bank. So can I say we're going to pay the interest one first of all, that's 225. And we're also going to pay the principal money, that is 1/4, 2,500 on this date. Finally, we've reached the 4th quarter of the first year. And you need to make another ledger on a 7 lines for the next year as well. So let's get now the balance CD. I'm not making the second year ledger. I think the first year ledger will give you a base in terms of how the ledger is made for the next year. So I'm just going to take a balancing figure and close it at this stage. So let's see what is the balancing figure. I think this is coming to 4843. This is 4843. That is the balancing figure in the financial liability. So this is the accounting, how the accounting for year 1 is done. Similar accounting will be done for the year number 2 as well. I think that should be manageable. I think I can skip that. Say yes or no. I think you should say a yes because I think it's on the same lines. So can I skip the next year's calculations? Yes. So my case number 1 is done. Financial liabilities at AC is done. Now let's go to the case number 2. So this was case 1. Now let's go to the case number 2. Let's go back to the study material. And we're now going to look at FPTPL. So let's have a look in terms of FBTPL in this case. So I think there is one small little question which is given on FPTPL. Okay, I think not really in this case. Okay, I think there's no question which I can see on the concept of FPTPL, but I think that would be covered once we come to derivatives as well. I think we'll take care of the case number 2. But I think just to tell you that if you consider FPTPL, the changes in the fair value will go to the P&L. The concept of EIR would not apply. So let's, I think, go to the case number 3 now. So FPTPL will take care of derivatives later. Let's now go to the next case, the interesting one, financial guarantees. Yes, this is RTP May 21. Another wonderful question. That's on the financial guarantee accounting. Let's have a look at this. Question number 4, this is on the financial guarantee accounting. So practically now we are on case number 3. The case number 1, AC done. FPTPL will take care in derivatives once we come to derivative accounting. Now we are on case number 3, which is financial guarantees. That is RTP May 21. So this is on the financial guarantee. Now, before I read this question, I think it's important to first of all give you some thoughts at this stage that how the financial guarantee is going to be accounted as an actual financial liability in the books of the guarantor. So I think first let's understand one thing very clear. Let's say, for example, I think I'll just make a little background so that we are very clear on the thoughts. So let me first give you a little background on the understanding before we read the question. So we're looking at financial guarantee. So this is my case number 3. This is my case number 3 as far as financial liabilities are concerned. If there is a financial guarantee, first let's understand the broader picture. Let's say, for example, there is a holding company, and let's say there is a subsidiary company, and let's say there is a bank. Now, the bank gave a loan to the subsidiary company. The bank gave a loan to the subsidiary company, and the holding company gave a guarantee to the bank. So the loan is taken by the subsidiary, and the parent company gives a guarantee to the banker for the loan taken by the subsidiary. Now watch this carefully. The bank says to the subsidiary company that if there is no financial guarantee, I'll give you the loan at the rate of 15%. The bank says that if there is a guarantee, I'm going to give you, let's say, a loan at the rate of 12%. Now, there is definitely going to be a position where the loan with a guarantee and a loan without a guarantee will, of course, be at a different rate of interest. So the bank says that if you do not give me any guarantee, the interest is at 15. And if you give me a guarantee, it is definitely less, which is 12%. So now let's understand what is the benefit the parent is giving to the subsidiary. The parent is giving to the subsidiary, you can say indirectly, a benefit of 3%. This 3% benefit is what is given by the parent company to the subsidiary company. And that's the benefit, is the value of the financial liability in the books of the parent. So once this 3% benefit is given by this parent company, so in terms of financial guarantee, he will recognize the financial liability equal to the benefit given to the subsidiary, which is equal to the 3% interest which is saved. So the standard in India is very clear that if a parent gives a guarantee to the subsidiary's bank, You need to calculate what is the interest rate without a guarantee, what is the interest rate with a guarantee, and whatever benefit is the subsidiary company getting. Let's capture that as a financial liability in the books of the parent company. This is the initial recognition. So this is going to be what you can say is the initial recognition. The initial recognition of this liability is going to be equal to the benefit which the parent gave to the subsidiary. But what about the subsequent accounting? Last session, we were reading something in the study material and I said, blah, blah, blah. I said, we'll come back to that language. Let me now come back on this subsequent accounting and let's see what is the status in the study material, what we were reading last time. Now, if I just take you back on the concept of financial liabilities, that is financial guarantees, I'm just reading that part which I need. So I'm just reading that part which I need for financial guarantees. So this is given in the study material in the unit number 2. Now let's read about this financial guarantee. This is the subsequent accounting in terms of financial guarantee. Don't worry, we'll pen down a chart very soon after this financial guarantee, giving you the comparative position in terms of accounting financial liabilities initial to subsequent accounting as well. Let's read. It says the financial guarantee contracts, we're not talking of loan below market rate of interest, they are subsequently measured at the higher of the two. It says the amount of a loss allowance. Now let me explain what is this loss allowance. We're going to see when we come to the concept of impairment of financial assets. Sir, suddenly talking about impairment of financial assets? Yes. You can say that if the subsidiary company does not pay to the banker, if the subsidiary company does not pay to the banker, then the liability of the parent company will trigger in this case. So the parent company is supposed to sit down and understand that if the subsidiary does not pay, how much would I be liable to pay? It is basically, you can say, assessment of impairment from the banker's point of view. You heard me correct. Don't worry, I'll document this later. So what the parent company will say that, okay, let me step into the shoes of the banker and understand if my subsidiary does not pay the money to the banker, then the bank is going to suffer how much loss. So this loss allowance is a computation which is being done indirectly by the banker using the concept of expected credit loss. We're yet to see how the concept of ECL, expected credit loss, works. But when it says that you need to calculate the loss allowance in this case, it is like looking at the impairment. It is looking at the impairment of the financial asset from the bank's point of view. We need to see things from the bank's point of view that as a banker, if I sit down and I evaluate that what happens if the subsidiary company does not pay my money, then what is the expected credit loss? So we will apply the concept of impairment of financial assets, get the expected credit loss, and that is called a loss allowance. So the parent company will step into the shoes of the banker. The parent company will step into the shoes of the banker company and evaluate that if the subsidy doesn't pay my money, then what is the amount of impairment? What is the expected credit loss for which I need to make a provision? That's one. Second, it says the amount initially recognized less when appropriate the cumulative amount of income recognized in accordance with the principles of Ind AS 115. Let me put this in simple words. What I'm going to do, I will make the financial liability account at an AC. I will make the financial liability account at an AC. So in this particular case, this is nothing, but I will say, okay, let me make my financial liability at amortized cost accounting and let's see. What is the liability based on AC? What is the liability based on if there is impairment and my liability gets triggered? I will create my liability at the greater of the two. So not able to get this too clear. Don't worry. Don't worry. I will give you some more inputs with an example. But you just need to understand at this stage, financial guarantees are going to be accounted with a very specialized accounting on a subsequent basis. As a parent company, I will say, okay, let me continue this financial liability at AC. Let's see what is the value. Let me consider by stepping into the shoes of the banker that if there is impairment, what is the loss allowance provision to be required? So I will say, okay, let me take the value based on impairment. Let me take the value based on AC, and the liability is measured at the greater of the two. We'll see more logics. Let's come back to the question. So I'm coming back to the agenda on the financial guarantee accounting. Let's come back now with this inputs. Now let's read the illustration. Let's read the question and then we'll start solving. It says on 1st April X1, Sun Limited guarantees a 10 lakh loan of a subsidiary Moon, which the bank provided to Moon for a period of 3 years at the rate of 8%. The interest payments are made at the end of each year and the principal is repaid at the end of the term loan. So interest is paid at the end of each year and the principal is a bullet payment. It says if Sun Limited had not issued a guarantee, the bank would have charged Moon Limited an interest rate of 11%. So they gave him a loan at the rate of 8. But if there was no guarantee, they would have given a loan at the rate of 11. So what is the benefit the parent company gave to the subsidiary company? It's a benefit of 3%. So the first thing what you need to do is the capturing of the financial liability initially is at the benefit given to the subsidiary, so that advantage of the lower interest of 8 vis-a-vis 11%, that is the benefit. This is the value at which initial recognition of the liability will occur. Then he says on 31st March X2, end of the first year, there is a 1% probability that Moon may default on the loan. In the next 12 months, if Moon defaults on the loan, Sun Limited does not expect to recover any amount from Moon. So we can see that if a default occurs, which is got just a 1% probability chance. So we need to see that, okay, what is the expected loss? If the subsidiary company does not pay, what is the expected loss? So the expected loss is a 1% probability that he may not pay the money. Then he says in the next year, 31st March X3, the probability has gone up to 3% and it may default on the loan in the next 12 months. Now, what is this next 12 months? You'll be able to understand when we come to the concept of impairment. So as of now, let's not get worried on what is this 12 months. That part you'll understand when I come to impairment in detail. So right now, you just need to consider 1% chance of non-payment, 3% chance of non-payment, which means 99% chance of making a payment, 97% chance of making a payment. Provide the accounting treatment of the financial guarantee in the books of Sun Limited on the initial recognition and on the subsequent periods, that is 31st March X3. He's asking the accounting of this guarantee in the books of the parent, which is supposed to be a financial liability. Now let's see how the accounting of this financial liability will take place initially and subsequently in the books of the parent company. Let's solve this out. Question number 4. So in terms of the question number 4, the first thing is there is a financial guarantee and that is to be taken as a financial liability. So just to give you the dots again, this is my case number 3. I've not done case number 2 that we'll cover in derivatives. So but case number 1, FL at AC done. Now we're looking at FL, which is a case of a financial guarantee. Okay, so let's first of all see what is the Initial Recognition Act. So the initial recognition is equal to, you can say, the benefit given to subsidiary. The initial recognition will be at the benefit given to the subsidiary company. So whatever benefit you've given to the subsidiary company, what is the benefit? 3%. So let's consider 3%. What is the value of the loan? So the loan is for 10 lakh rupees and a 3% benefit is given every year. So 10 lakh rupees into 3%. and take a present value interest factor annuity. And this will be taken at 11%. So we'll take the discounting at 11% for a period of 3 years. So the benefits are given for the next 3 years. The subsidiary gets the benefit of 3% interest saving for the next 3 years. That is the period of the loan. So 11%, that comes to 1, 2, 3, 2.444. This comes to 2.444. This is the present value of the interest saved. So on 10 lakh rupees, there is a 3% into 2.444. This comes to 73,320. This is the initial recognition. So as I said very clearly, the initial recognition is done equal to the benefit which the subsidiary gets. Had there been no guarantee, he would have got interest at a rate of 11%. Because of the guarantee, he gets the interest at 8%. The 3% benefits given by the parent company becomes the base of recognizing the financial liability initially. Now let's go to the subsequent measurement. Now let's see what is going to be the subsequent measurement in this case. So in terms of subsequent measurement, the standard says you need to consider the higher of the two. You calculate a loss allowance. You calculate a loss allowance if there is supposed to be a non-repayment by the subsidiary. What is the status? And you will calculate the financial liability at amortized cost in simple words. Now let's see what is the loss allowance and what is the financial liability at AC. Let's come back. So in this particular case, it says on March X2, there is a 1% probability that Moon will default on the loan. So Moon will not pay 10 lakhs, 1% chance. Moon will pay the entire 10 lakhs, 99% chance. So we need to see the expected loss. How much he will not pay? He will not pay 10 lakhs. There is a 1% chance. He will pay everything. There is a 99% chance. So indirectly, when you do the calculations, how much loss will I suffer? I will suffer a loss of 10 lakh. There is a 1% chance. I will suffer no loss. There is a 99% chance. As a parent company, I'm trying to step into the shoes of the banker, and I'm trying to visualize that this 10 lakhs will not be paid. That means I will not recover 10 lakhs, 1% chance. I will get everything, so there will be no loss to me. So either I'll suffer a loss of 10 lakh, there is a 1% chance, or I'll suffer nothing, there is a 99% chance. So you can calculate a loss allowance, 10 lakh into 1%, that works out at 10,000. Your liability needs to be measured at the amount which you might be liable to pay, right? So they say that visualize that if the money is not paid with a subsidiary, then in that particular case, what are the chances the banker could suffer how much loss? By stepping into the shoes of the banker, you realize that this is the amount of money which you may not recover. And now let's see the financial liability at AC, for which I'm making a ledger account for ease of convenience. So what was the financial liability measured at? It was measured at 73,320. Just do the normal accounting of a financial liability, unwind the finance charge, and see the benefits given to the subsidiary every year. The benefits given is 3% benefits on 10 lakh, 30,000 benefits is being given every year. So what we did initially, we said, okay, we are giving a benefit of 30 every year. Let's take a present value. Then what do? Compounding. I gave you the basic rule in India is that if you do discounting, then what do you need to do in the future years? Compounding. So 73,320, we take a 11% finance charge, 8065. The benefits given to the subsidy is 3% on 10 lakh. So you get a balance CD balancing figure. So 73,320, 8065 minus 30, that comes to 51,385. That's like financial liability recorded at amortized cost. Now you know that if, just imagine, if this amount was more than 51,385, you need to upgrade your financial liability. You need to upgrade your financial liability. So in this particular case, the losses which could occur is much less. So we carry forward the liability at the greater of the two. Now you can see why the greater of the two. A normal accounting is done, financial liability at AC, but you at the same time visualize that if the subsidy doesn't pay, how much liability could occur. So if your value of loss is much more as compared to this liability, you need to upgrade the liability. And any change in the liability is accounted FPTPL. So when you consider higher of the two, so you can say the higher of the two in this case is this. So now you compare these two values and we can say in this case the liability has come down. Since the liability has come down, the subsequent entry is financial liability gets a debit and the profit and loss gets a credit. So difference between 73,320 minus 51,385, this difference is going to be captured in the profit and loss account. So once you calculate the financial liability at the higher of the two, initial recognition, subsequent measurement, the difference is taken in the P&L. So 73,320 minus 51,385, 21,935 is taken in the profit and loss. And the value of the liabilities would have gone up. Let's say if this figure would have been, or this figure would have been more than 73,320. It's time to enhance the financial liability because somebody who took a loan doesn't pay, then I become liable to the bank. So I need to increase or decrease my financial liabilities accordingly. I hope I'm making sense on this. Okay, let's also see the next year as well. Now, I get a question, so why 11% is used? Technically speaking, you can say without the guarantee, the interest rate would have been 11%. So if you now come on to the concept of discounting in terms of Ind AS, we always consider the interest rate which would have been. Like for example, in CFI, what did you do? You took the interest rate on a non-convertible instrument. So here again, if you want to capture the liability, you need to consider if there was no guarantees given, what is the interest rate? So the interest rate which I would have paid otherwise, had there been no conversion option, you would have paid interest on non-convertible. Had there been no guarantee, you would have paid interest on the interest without a guarantee. So every time the discounting rate occurs, we consider which would have been had there been no conversion option, had there been no financial guarantee. Just giving you the parity of thoughts to think. Got it, I guess? Okay, so this is 1 year. Let's now look at the second year subsequent accounting as well. Let's go to the next year further. Let's consider the subsequent accounting for the next year as well. That was 1 year later. Now this is 2 years later. Subsequent accounting, which is second year end. That was first year end. So this was subsequent accounting at the first year end. Let's also see the accounting at the second year end. Now in this particular case, again, I'll say, okay, let me consider the higher of the two. Let's see what is the loss allowance. By stepping into the shoes of the banker, what is the loss allowance? And let's see what is the financial liability at amortized cost. And let's see whichever is greater. Let's go back on the question. So it says on March X3, now there is a 3% probability that Moon will default. So we can say in this case, 10 lakhs will not be paid. There is a 3% chance. So the banker could suffer a loss of 10 lakhs. There is a 3% chance. The banker will not suffer any loss. There is a 97% chance. So you compare, and this I think works out at 30,000. And if you make a financial liability at amortized cost to get the picture, so let's take the balance BD from the previous ledger. So this is 51,385. This is 51,385. Let's take the unwinding of the interest at 11%, 5652. The benefits of 3% given to the subsidiary company. Let's see the balance in this case, 51,385 5652 minus 30, this comes to 27037. Now, this time we can see that the value which is the greater of the two, we can clearly see the greater of the two in this case is 30. This is the higher of the two. Now go back and see what was the financial liability in the first year. The financial liability was captured at 51,385. So the financial liability was captured at 51,385, and this liability needs to be brought down to 30,000. This liability needs to be brought down at 30,000 in this case. So we again put the entry reducing the financial liability and putting the difference in the P&L, that is 21,385. So the financial liability at the end of first year is standing at this figure. We need to bring it at 30. So there is a reduction of 21,385. Wow. Financial liabilities accounting, all the cases done except the special cases, liability arising when derecognition cannot occur. That's one. And also the case of CC, that's another, that would be taken in 103. Designated, also not done. FPTPL, that will be taken care when we come to the point of derivative accounting. Financial liabilities accounting done. The blended Index 21 is left. Now what we're going to do, we're going to make a summary chart. Just like we did that in terms of financial assets, we're going to make a chart on the financial liabilities as well, giving you a comparative positions of all the permutations, combinations. Wow. Let's now make an interesting chart summarizing the position of financial liabilities accounting. So do we recognize the finance charge in the books? No. That is just the calculations wherein we are just trying to measure the financial liabilities in this case. So we are just going to consider the remeasurements of the financial liabilities, and that's it. You know, I remember if you want to have a look at a practical financial statements also, where this kind of accounting is brilliantly shown, and you know, the financial liability is increasing because of this guarantee. Look at the financial statements of GVK. Look at the financial statements of GVK, a company which has, I think, recently gone into insolvency. And you can see what happened in that particular case was a very interesting situation practically, where you can see that a company which is, you know, the subsidiary of GVK in Singapore. So there is a subsidiary of a GVK company. GVK company is in India and the subsidiary is in Singapore. And they've taken a bank loan from ICICI Bank running in millions of dollars. And the subsidiary company is unable to pay this money. And the ICICI Bank, you know, asks for the insolvency of this company, GVK. You must have a look at the financial reports of GVK to get more clarity of thoughts in terms of how the financial guarantee accounting is done. So the GVK company, the ICICI Bank says that your subsidy company is not able to pay my money and therefore you need to pay him. Now this poor chap is also unable to pay that money because the money which is taken by the subsidy company is running in millions of dollars and he's unable to pay. And they say now we go to the insolvency board and say that your company needs to be, you know, triggered as insolvent company because you're not able to pay my dues. The parent company goes on an insolvency at the direction of the ICICI Bank in this particular case. Wonderful treat to see. You know, just for the understanding sake, I have no animosity against the company. Just an example I'm giving you to understand the reality picture as well. Okay, so I think I am getting another input question on this. Okay, so got it, but ICAI recognized the financial guarantee as a contingent liability, then why a change of concept was needed, which led to the standard in this case? Okay, now that's a very good question. Yes, you're right. If you look at the ICAI, financial guarantees have always been, you know, captured as a contingent liability in the books of accounts, unless the liability is something which becomes a present obligation. But don't you think so? That is, you know, technically not correct. Now, let me also tell you something more at this stage. Don't find this as a criticism. This is just a, you know, a kind of things which are getting updated in the accounting world by the International Accounting Standard Board. You know, technically, if you ask me, the concept of deciding what is contingent and what is a case of provision in Index 37 itself seems to be, you know, quite, I think, a backseat kind of accounting. I'll tell you why. It's like deciding something, provision, contingent liability, provision, contingent liability. Now, trust me, the moment you say contingent liability, it goes in the notes to accounts. And that liability is what is technically called, you can say, an off-balance sheet liability. And whether it'll trigger or not, there is a 50% chance, there is a 20% chance, or there is a 2% chance, God knows. The International Accounting Standard Board is now working on a new agenda. The concept of contingent liability might get deleted from the dictionary of accounting. You heard me correct. They're working on the agenda of, the concept of contingent liabilities will disappear from the accounting world. Everything should be captured as an actual liability. If the probability of that liability is below 50, you can capture a small amount. The measurement of that liability could take care that, okay, if the chances of that liability triggering is less, you create a lesser liability. If the chances of that liability getting triggered is more, you create a larger value of liability. The measurement of the liability should incorporate the probability of occurrence. But why should you say that the probability is 49%, it is notes to accounts, and if it is 51%, it gets captured as a provision in the books of accounts? Don't you see that this is, not exactly a good accounting? You say it is 49 notes to accounts of balance sheet liability, 51% it gets captured as an actual liability. The 2% makes a difference. एक चुटकी सिंदूर की कीमत तुम क्या जानो राम बाबू? Did you get my point? So in this particular case, the concept of deciding, it's contingent, it's a provision, no, it doesn't make sense. So they're working on the new parameters of capturing all liabilities as actual liability. So maybe the probability could consider the value, the amount of liability gets larger or smaller based on the probability outcome. But why you should allow companies to show contingent liability? Tomorrow the company goes into liquidation, a huge level of liabilities are standing against the company, all of balance sheet items not on records. Right? Great. Okay, so now I think let's pen down a chart. Then I think after that we'll give you a break. So let's first make a chart on the financial liabilities. Then we take a break and then we come back to the questions on Ind AS 109 and 21 combined. Okay, so let's make a super summary chart. We are making a summary chart, and this is on the financial liabilities accounting. So let's make some permutation combinations to put it all together. I would say I'm looking at 4 kinds of liability, technically speaking. So I'm looking at financial liability AC, FPTPL, designated FPTPL, and financial guarantees. So let's take a column particulars. Let's take this as AC, FPTPL, then it is FPTPL, which is a case of designated at FPTPL, and then we've got financial guarantees taken separately, though this is also indirectly at FPTPL. Okay, let's, I think, begin the inputs in this case. So we can say, first of all, on the initial recognition, can I say this is going to be at a fair value minus the TC minus the processing fee? So I think I'm also pinpointing that processing fee is typically applicable to financial liability ACs. I'm not going to talk about the processing fee in other cases. So we can say that the processing fee is applicable to this category, is applicable to financial liabilities at AC typically. This will be at a fair value. In this case, we can definitely say that TC is immediately expensed off. The TC is going to be immediately expensed off in this particular case. So the TC goes in the P&L. I'm not talking about the processing fee. And in terms of FPTPL, initial recognition at a fair value, and the same concept goes for TC. Now, in terms of the financial guarantee, the initial recognition is at a fair value, which is supposed to be the present value of benefits. which is the present value of benefits given to the subsidiary company for that matter. I saw a very interesting case in the practical world as well. And that is very interesting. I saw a case where the parent gave a subsidiary, the subsidiary took a loan from the bank. And in this particular case, the parent gave a guarantee to the bankers, and the fair value of the financial guarantee was zero. I was quite surprised looking at that. I said, financial guarantee becomes zero. Why is it zero? Some way or the other, interesting inputs. Sometimes the situation becomes like this. The loan is taken by a stronger party, and the guarantee is given by a party who is not as strong as the borrower. So the parent company is supposed to be, weaker as compared to the subsidiary company. And the banker says, with your guarantee or without your guarantee, the loan interest rate remains the same. So people at times try to manipulate things practically as well. And they say, that the parent company gave a guarantee to the subsidies company loan. The banker is saying that, your parent company is smaller as compared to the subsidiary. So by giving a guarantee, it really doesn't reduce your interest rates. We give you the interest at the same rate with or without guarantee. Surprising, difficult to digest, but you see these kind of things sometimes done by people in the practical industry. And that's difficult to digest. Because how can the bank give you a loan at an interest rate which is equal with or without guarantee? Surprising. Happens. Okay. So this is the present value of the benefits which is given to the subsidiary company. Okay, next, let's go to the second agenda. The concept is regarding the EIR. So is the concept of EIR applicable? Is this concept of EIR applicable to AC? Yes. Is it applicable to FPTPL? No. In this case, I'm putting it as no. Though you do the accounting for the calculation purposes, but per se, the concept of EIR does not apply. Okay, let's, I think, go further on the next agenda with you. Okay, the next one we've got, number 3, is the subsequent measurement. And when I say subsequent, I'm looking at the fair value changes in this case. So can I say the fair value changes in this case is not applicable? We do not capture the fair value changes in this particular case. FPTPL, yes, it goes in the P&L. And in this case, yes, but in this case, the changes in the fair value is split between two components. So we can say the fair value changes due to own credit risk. The fair value due to own credit risk goes in OCI, and you can say the rest of the fair value changes goes in the P&L. And in terms of financial guarantee, the subsequent accounting it is captured at the higher of the two. It is captured at the higher of the two, the calculation of the loss allowance or the calculation of financial liability at AC, whichever is greater. And I think in this particular case, worth making a mention, that you can say in this particular case, any changes are taken to P&L. So any changes in this case will be taken in the P&L. So whether the financial guarantee goes up or down, the fair value gain or loss is captured in the P&L. Okay, so I think the initial recognition done with TC as well as the concept of processing fee, EIR subsequent changes done. I think that's it. Doesn't have much more things. Impairment concept is, of course, not applicable in terms of financial liability. Impairment is related to the concept of, you can say, the financial assets. Anything else which comes to your mind on the financial liabilities as well? And I think, let me just put it, this will be a case of generally derivatives in nature. So we have seen AC, we have seen financial guarantee. This portion, derivatives, we'll see once we come to the derivatives. Right, friends? So far, so good. So I think before we go further, let's, I think, first get your comfort zones. Let's, I think, get your comfort zones on a scale of 10 on the understanding of financial liabilities, how comfortable you are on the financial liabilities accounting. On a scale of 10, let's get your comfort zones on this. So we get a score 9.5. That's wonderful indeed. Another one also 9.5. Wow, I think 9.5 seems to be a good choice. Okay, so I think this pens down a thought on the first major area on Index 109, financial assets, financial liability, initial, subsequent, done. Now, how do you map your mind in terms of all these things? So there are a total of five categories of financial assets with five special issues. There are a total of, you can say, four categories of financial liabilities with three special issues. One is with regard to the elimination of accounting mismatch, which results in designating it as APTPL. The TC and the processing fee is done. Now, what we're going to do, we are going to merge the concept of a learning so far with Index 21 and do two very interesting questions which came in the RTP. But I think before that, let's give you a break and then we'll start with Index 21 factor. After those two questions are done, we'll start a grounding work on the concept of next special areas, derecognition of financial assets and liabilities in the books. But I think let's first give you a break. Let's relax your mind 10, 12 minutes and then we start back. Oh, thank you. You connected the dots in the break as well. So now we are going to do questions which I said a blend of 109 as well as Index 21. So one is on a financial asset, one is on a financial liability. Let's have a look at them. So these are two questions which came in the RTPs. So one is RTP May 2020. And that's another question also which came in RTP in November 2020. It's a very interesting question. Let's, I think, first read the details. I guess it's visible to you. So let's have a look at the question number one, which is pertaining to the foreign blend of it. Let me just also open this for me. Okay. It says on 1st April 2000 X1, M raised a long-term loan from foreign investor. So when he raised a long-term loan, I think that's quite indicative that we're looking in terms of a financial liability. The investors subscribed for 6 million foreign currency loan notes at par. An incremental issue cost which is given, so that is supposed to be TC. And then it says interest of foreign currency, 6 lakh is payable annually on 31st March, starting from 31st March X2. So the interest is payable in arrears. The loan is repayable in foreign currency on March X7, and that is at a premium. So we can see two things already at the very start. There is a TC and there is a premium which is payable on redemption. And I think your mind would start triggering that this will lead to the concept of EIR, because if there is a premium, there is a discount, there is a TC, there is a processing fee, it's going to trigger EIR. And then it also adds on further inputs out here. It says the effective interest rate is 12% and the appropriate measurement base is AC. He's already given us that this financial liability is measured at amortized cost approach. Then he says the relevant exchange rates at the beginning of the year, at the end of the year, and the average rate of exchange is given. And it says the functional currency of the group is supposed to be Indian rupees. So it's a foreign currency loan and a functional currency is Indian rupee. So therefore, Index 21 comes into play. What would be the appropriate accounting treatment of the foreign currency loan in the books of M for the year X1, X2? Calculate the initial measurement of the loan, calculate the finance cost for the year and the closing balances as well as the exchange gain as well as loss. I think pretty good question indeed. So my piece of advice is when you're doing this kind of a question, at the first instance, I would say, forget about the concept it's a foreign currency loan. You know, there is a very simple trick of doing this question, and that is, first of all, do the question as if there is no foreign currency involved. Just make a normal financial liability ledger at AC. Then we'll see the conversion rates and consider the implications of Index 21. So in order to do this particular question, what we're going to do, first of all, forget about the concept that there is any foreign currency. So let's do one thing. As you make a ledger account, the best way to do this is make two columns. The best way to do this is make two columns. One is for the foreign currency and one is for the functional currency, and we will be able to easily get the data points. So whenever you see that there is any blend of foreign currency involved, just go with the flow. Just do the question as if the foreign currency, ignore the foreign currency, just do the question normally and then keep converting to functional currency. So this is foreign currency and this is functional currency. So making two columns on the debit and the credit side, so foreign currency, and then there is conversion into functional currency. So we're making the financial liability at amortized cost. We'll do absolutely a usual accounting and then see the impact. So I think let's look at the data points and start. Okay, so I think first of all, we can see that the company raised a loan which is 6 million, 60 lakhs, and the TC is 2 lakh. So can I say we'll put the entry that is bank. So the proceeds are 60 lakhs and the TC is supposed to be 2 lakh. So we recognize the liability at a net figure, which is 58 lakhs. And then what you need to do, you need to calculate the finance charge based on EIR. So let's consider the finance charge, and the EIR is also given. It's at the rate of 12%. So we take the interest at the rate of 12% on 58 lakhs. 12% would mean 6.96 lakh. And then there is a payment which is done. And as far as the payments are done, we are making a payment of interest of 6 lakhs at the end of each year. So we make a payment that's to bank. And this is made at the end of the year, that is 6 lakh. As simple and as straight. So we're done. You can now get the balance CD as a balancing figure. We have ignored the concept of Ind AS 21 at the moment. So let's consider the balance CD balancing figure. So 58 plus 6.96 minus 6, that comes to 58.96 lakh. Okay, now we just need to apply the concepts of Ind AS 21. So we need to convert this in terms of foreign currency. By the way, is this loan a monetary or a non-monetary item? Now, I don't know if you've done Ind AS 21 or not. I think yes. Are you done 21? Otherwise, I'll just tell you the inputs. So aware of the concept of Ind AS 21? Yes, done. Great. So that's rightly said. It's a monetary item. And if it is a monetary item, then the restatement is to be done at a closing rates for the closing liability. But we need to apply different exchange rates to different amount. So when you took the loan at that stage, the rate of exchange which is given in the question. On 1st April, one foreign currency is at the rate of 2.5. So when the loan was taken, one foreign currency was at the rate of 2.5. So this works out at 145 lakhs. Now, as far as the interest is concerned, can I say this interest is recorded, which is an expense in the P&L, and income and expense will be taken at the average rate. It's 2.42 per currency unit. So 6.8432 lakhs. That is the interest, applying the relevant exchange rates in this case. Okay, next input I am given. Now, this payment is made at the end of the year. Remember, this payment is made at the end of the year. So you need to apply the exchange rates at the end. So the exchange rates at the end is 2.75. You convert the closing liability also at the closing rate. So 6 into 2.75, that works out at 16.5 lakhs. And 58.96 into 2.75, that works out at 162.14 lakhs. Now, will there be a difference in the ledger account? Of course, yes. And where will you take the difference? Is that a difference on account of 109? Or is that a difference on account of Ind AS 21? Tell me. When you're looking at a difference in the ledger, this is due to the conversion factor. So it relates to Ind AS 21. That's right. So in this particular case, we'll see the balancing figure, and that will be taken in the P&L. Monetary items restated, the gain loss goes in the P&L. 162.14, 16.5, 145, 16.8432. So I think we're getting a balancing figure on the other side, 16.7968 lakhs. 16.798 lakhs. That is the balancing figure. This will go to the P&L, and this is supposed to be the foreign exchange loss arising on account of Ind AS 21. Wow. The question is done. Can you believe it? The question is done. So the easy exercise is that you first make your ledger account in a foreign currency. Forget about the concept that there is any kind of foreign exchange involved. Make your accounting in a normal manner, and then you can apply the relevant exchange rates to the relevant item. At the beginning, the rate which was prevailing when the loan is taken, interest being an expense and an average rate. The payments are made at the end of the year, so closing. the restatement of the liability, which is monetary at a closing. Any difference becomes exchange gain loss in the P&L. Great. So this is done. Now I think let's go on to the next question with you. This was May 20 RTP question. Now let's have a look at November 20 question as well. Let's have a look at question number 2. That is also one of a very interesting question indeed. So let's have a look at this particular question. It says an Indian entity whose functional currency is rupees purchases USD denominated bonds. When it says it purchases, that means we're looking at a financial asset. So therefore, purchase words means investment. It purchases USD denominated bonds at a fair value of $1,000. The bond carries a stated rate of interest that is contracted, and the said interest is received at the year-end arrears. The bond has got a maturity of 5 years and is redeemable at its face value, that is $1,250. Now, when you buy it at a fair value of 1,000, and in this particular case, I am given that the face value is $1,250, that seems that there is a bond. Either in this particular case, the bond is purchased at a discount, so indicates EIR. And then it says the fair value of the bond is 1060 at the end of the year. Exchange rate on the rate of transaction at the year 1 end is given. So we're given the transaction date, rate of exchange on the rate of transaction, 40, year end is 45, and the weighted average exchange rate is 42. The entity has determined that holding the bond as a part of the investment portfolio, whose objective is met both by holding the asset to collect contractual cash flows and selling the asset as well. So I think the business model is very clear, and the business model tells me that it is to buy or it is to sell. It is to keep till maturity as well as sell. The dual model indicates that it is FPD OCIR. It would be a debt investments. So it says also clearly the bond is classified under FPD OCI. I think that was not required to be mentioned. I think that is implied. The EIR is already given 10%. Calculate the gain or loss to be taken in the profit and loss and the other comprehensive income for the year 1. You are required to pass journal entries in this case. Okay, so I think we can see the data clearly that this is undoubtedly a debt investments, and the business model is to collect as well as to sell, and therefore it becomes FPT OCI. Debt investment is always R. Forget about the concept of foreign currency at the moment. Just do the question as if it's a normal question altogether, and then we'll take care of the foreign currency element as well. So question number 2. So this is financial asset, because here we have made an investment. So this is a financial asset. We'll make again 2 columns the way we did in the previous question. So we'll take one foreign currency and we'll take care of the functional currency conversion. So foreign currency can be tackled later. First, make a normal accounting. So this is the financial asset which is accounted at FVTOCI, that is with reclassification. So this is the foreign currency. This is the functional currency. And same goes on the credit side. This is the foreign currency. And this is the functional currency. And I think let's pick up the data for the very first year which is given. So it says you made a purchase of the bonds at a fair value 1,000. So this is bank. The initial recognition is at a fair value. I am not given any TC, so this remains at 1,000 itself. Then next we need to consider the interest income. The interest income will be taken at the EIR, that's at the rate of 10%. So we take care of the finance income at the rate of 10%, that is 100. And there is interest which you are receiving at the stated interest rate. So the interest is at the rate of 4.7% on the face value, and the face value is 1250. So we get the interest on 1250 at a stated rate that is 4.7%. As simple as that. So this comes to 1250 into 4.7. So that's almost like 59. If I round it off, it comes to 59 in this case. And that's it. Nothing else is given. So what is the value at which you're going to capture this financial asset? Are we going to take a balancing figure or are we going to consider a fair value? This is FPTOCI. So do we capture at a balancing figure or at a fair value? And that's right. This is going to be captured, of course, at a fair value. That is correct. So we know the fair value in this case is given to me. Okay, so question asks, present leisure in the exams, is it allowed? Okay, I got a point. The question says give journal entry and I'm making a leisure account. You could do this in the working note and then you can present the entries. Trust me, it is more easier to make a leisure account. So I would say what I'm doing technically is supposed to be a working note. Then from this working note, you can easily draft entry. But you need to stick to the fact, if he's saying journal entries, you need to give journal entries only. Right. Okay, so that's right. So we consider the things at a fair value. That is correct. Okay, so let's see what is the fair value at the end of the year. And I'm given the fair value at the end of the year is 1060. So this becomes the balance CD 1060. Let's see what is the balancing figure in this ledger. So the balancing figure in this ledger, where will it go? OCI. Because it is FPT OCI, so any difference will enter the other comprehensive income. So this is to the extent of, I guess, 19 is the difference we're getting on this side. So this will be taken in the other comprehensive income. It's an unrealized gain, and that will enter in the OCI, and from there it goes to the tab number 3, which will be reclassified on realization. Okay, now we need to consider the conversions at the currency rate. Let's now take the conversion. So when the bond was invested, the date of transaction, the rate of exchange was supposed to be 40. So this will be taken at the rate 40. The interest will be taken at an average rate. This is the finance income, which is captured at the average rate, that is 42. The payment is collected at the end of the year, so this will be at 45. And then, is this supposed to be a monetary item as well as per Index 21? So this investment is made in a debt. So is this also going to be restated at the closing rate? Yes. So multiply this with 45. And this 19 is also computed at the year end. So multiply this with also with 45. So this is going to be 40,000. This is going to be 4,200. And this is 855. And this is going to be 2655. And this is going to be 47,700. So applied the relevant exchange rates to get the functional currency data. And then finally, we need to get a balancing figure in this ledger. Now, where are you going to take the balancing figure? Of course, a restatement of monetary items, so difference goes in the P&L. So let's get the balancing figure in this case. 47,700, 2655, 40,000, 4,200. I think we're getting a difference of 5,300 on the debit side. So this is going to go to the profit and loss. It is supposed to be a foreign exchange gain. And that's what the question is indirectly asking us. So I would still insist, it is better that you make a leisure account. It becomes a little more convenient. So all this goes in the working note, and then you can make entries out of this. I feel if you're going to make entries directly without a leisure, it can be, quite technical indeed. Making a leisure account gives you a control factor of the figures. So this could be, as a part of the working note. So I think I don't need to make entries. I think you can easily manage entries out of this. Okay, so far so good. So this is also done. So Ind AS 21 and Ind AS 109 blends done. Our main journey on Ind AS 109 gets covered at this stage. The initial and the subsequent measurements of financial assets, financial liabilities, all done. Now we go on to the concept of the four special issues in the standard. And I'll just take a little moment to first, give you a little grip in terms of how we have proceeded. Because I hope your cumulative revisions are going on, but I'd just like to connect with some data points at this stage. That how you're going to make your revisions, I'm just going to give you a thought process. I'm spending 5 minutes on that, but I think it's much needed so you are absolutely clear on the flow of the standard. Because when the standard becomes big, the main issue is in terms of, how do I bind it in the mind? So I think I'm going to do a small little mind mapping at this stage. I'm just going to make a small little mind mapping to you at this stage. I'm not going to give you any inputs in terms of revisions. I'm just going to give you a chain of thought, how you're going to make a revision of the standard. So our journey started on a very interesting note. Our journey started on a very interesting note, and we said that we're looking at two parties. One is the issuer and one is the holder. So we decided that when we started our inputs in terms of Ind AS 32, I first of all started from the point of view of Ind AS 32, looking at the issuer perspective. And I gave you, if you recall, a three-step model. I gave you a three-step model, and there were three versions of the models which I gave you. There were three versions of the model, but you need to remember the third version which I gave you. So the three-step model, the third version which I gave you. And along with this three version, I'd also given you three charts as well. So all three. So I gave you a three-step model, and that was the third version, which you need to remember, with the three charts. And on this particular basis, we were able to classify the instruments in terms of pure FL, in terms of pure equity instruments, in terms of non-derivative CFI, or in terms of hybrid instruments as well. So I gave you the inputs in the mind that you've got a pure FL, non-derivative equity CFI, as well as hybrid. Now, let me also tell you, along with this in the study, we're also given the concept of deemed equity instruments as well. So where I said that the inputs in terms of the para number 16A to para number 16D, the concepts are given, though this is not being touched in the exams till date. Fortunately, unfortunately. So I didn't get into that part, but this is also another area which is given. This was all in terms of Ind AS 32. And then you also need to consider that the CFI accounting we covered here. So we covered the concept of split accounting. We covered the concept of split accounting. And if you remember, I covered the concept of a perpetual loan. I covered the concept of, the case of optionally convertible, mandatorily convertible, partially convertible. So we cover four types of compound financial instruments with you. And we also learned how TC is treated. We also learned the aspect of how the TC is treated, and we also learned the aspect of another thing, and that was, you can say, early redemption of CFI. That was a special issue done. So your mind should get mapped completely that in terms of split accounting, we did four types of instrument, made some extensive charts also with you. The TC, it was treated, and the early redemption. So this was Ind AS 32 journey, which was carried out. Then our focus shifted in terms of holder, and we came to the concept of Ind AS 109. And in terms of Ind AS 109, we said the financial assets were broadly divided in terms of two categories. One is the debt investments and one is the equity investments. The debt investments were divided in terms of AC, FPT, OCI, that is recycling, and in terms of FPTPL. And equity investments were FPTOCI, that was no reclassification, as well as FPTPL. So we concentrated completely on the financial assets accounting, and wherein I covered the concept of 5 special issues with you. So when I did the concept of the financial assets, we covered a total of, first of all, I gave you a 3-step model here as well. So I gave you a 3-step model here as well in terms of classifying based on those CCFC, SPPI test, as well as the business model and the held for trading test. We could take a decision that financial assets are done. So classification from the issuer point of view on a 3-step model, classification of the financial assets also on a 3-step model. Get the flow in which you need to map your minds. And then I covered a total of 5 special issues with you. I covered the area of 5 special issues with you on the concept of a financial asset. So wherein we covered the concept of transaction value and a fair value differences and all. So in this particular case, I think I'll just quickly pen them down. So in terms of the 5 cases, we covered the aspect of fair value not matching with the transaction value or the transaction price. So we did this. And here again, we covered a total of 3 kinds of cases based on the kinds of relationship which were there. Then we covered the concept, in this case, a loan which is payable on demand. How is that accounted for? Then I also covered more cases on financial assets with you. I'm forgetting which were the 5 cases now. So I think one, of course, was the fair value NTP. One was the loan which is payable on demand. Then I think I covered 3 more cases with you. What was that? So I think since there's so much things going at the back of the mind, I think I'm also forgetting the 5 special issues which I gave
Early
you.
payments, sir. Early
Yes,
payments.
early payments. Yes, you're right. So there was an early prepayment, rather, let's put it. Yes, you're right. More. So I did the case of a prepayment of concession loan. That was another one. And what was more? You have it on the registers. I guess what was the next issues which I gave you? You can maybe have a look at your registers. Nobody remembers that. Oh my God, everybody's looking at the registers at this stage. Okay, so I think there were 2 more issues which I remember. I gave you a mind map chart also on that, where I said, fair value, transaction value differences. Then I gave you the concept of loan payable on demand where the interest doesn't apply, repayment of concession loan. Can you just turn your pages and tell me which 2 more cases? So the mind map looks good. Okay, maybe we're not going to get that. Let's see if you can search it in the notes. Okay, then after this, once the 5 special cases were done, nobody remembers that. We did 5 cases. I gave you a chart also on that. Not even a single person remembers all that. Employer lessee, that 3 cases already covered out here. If you made a chart which I gave you 5 special issues on financial assets. So wherein I said there were 5 issues. I made a chart where I wrote down 5 special issues relating to the financial assets here and there. I think maybe nobody remembers that. Anyway, then I think let's go further. Okay, so then in terms of the financial liabilities, then we came on to the accounting as far as financial liabilities are concerned. And in terms of financial liabilities, we said that there are 4 types of financial liabilities. We understood the 4 types of financial liabilities, and I gave you a list of 3 issues in this case. And the 3 issues, okay, the 4th one I remember now, processing fee. The 4th one was processing fee, which I remember. There was another 5th one also. I'm not getting that in the mind at the moment. I think somebody sent me the inputs on the 5th agenda as well. Processing fee and Index 21. Yes. The 5th agenda was, I think, let's put it like this, combined. So financial assets and financial liability. The 5th agenda was merging Ind AS 109, which we've done today, plus Ind AS 21. And these three issues was regarding the mismatch concept. One is on the concept of mismatch, one is on the concept of processing fee, and one is the concept on TC. Wow. So this is the journey so far in terms of Ind AS 32 and 109. Now the accounting of FL is done, CF is done, hybrid is done. Equity, we never did the accounting because equity accounting is just accounting for equity shares. This is the core portion, where we get a lot of questions in the exams. But nevertheless, don't assume that what is left over in the standard is not comes in the exam. It gets touched. Now, apart from this, we are covering now 4 special issues. So apart from this, whatever I've given you in the chart out here, now there are a total of 4 issues, 4 special issues which are discussed in the standard. And we are now going to start a journey on those 4 special issues with you. So what are the 4 special issues? One is derecognition. One is derecognition of financial assets and financial liabilities. That's a good area because we do get questions in the exams on the derecognition concept. Then the other concept is as far as impairment of financial assets is concerned. So impairment of financial assets, this is the concept which we call ECL, that is expected credit loss. We had a very basic flair of this when we were talking today in terms of financial guarantee. Then there is a concept which is called hedging. And then there is another concept which is accounting for that embedded derivatives. That is accounting for the embedded derivatives in this case. Okay, so these are the 4 special issues. So we'll discuss these one by one. We'll go to almost the same, order itself: derecognition, then impairment, then hedging, and the embedded derivatives as well. Wow. I hope, friends, now you're able to get the complete thought process of how the flow of the standard is going on. Because I think, to my mind, this is today the, almost the 8th class, and I think we stand at a good journey of coverage in terms of financial instruments. Now we're going to concentrate on these 4 special agendas of discussions with you. Let's begin the journey now. I am now going to start with the concept of derecognitions with you. And this is going to be a bit technical. Somehow or the other, we almost reach, on the last half an hour of the area where things start getting a little technical. And you're going to see that, things might be a little heavier now for the next half an hour as well. But don't worry, we'll try to ease out and give you a simplified explanation on things. Let's begin. So I think I'll just take this after the inputs of these notes. So let me go further. So let's now go to the next area of discussion, and that is derecognition. So special issue number 1. We're coming now to the special issue number 1 in terms of Ind AS 109, derecognition. So we'll do our discussions in 2 parts. I'll discuss the derecognition of financial assets separately, and I'll discuss the derecognition of financial liability separately. We're going to discuss the derecognition in 2 parts. So first we'll look at the derecognition of financial assets, and then we'll look at the derecognition of financial liabilities after that. Now, I always give a very simple example to people in order to first of all understand the concept of derecognition. So before I take you to the technicalities of derecognition, I'll first of all give a very basic example to understand the concept of a derecognition. Imagine if I go back to school and I am looking at some sequential entries which we learned in class 11th. I'm sure you all remember what you did in class 11th was a chapter called Bill of Exchange. And I always give the same example to people to understand the concept of derecognition of financial assets. Imagine you made a credit sale. So when you made a credit sale, you can easily vouch me the journal entry which will be done at the time of credit sale. The entry would be debtors, or you can say trade receivable gets a debit and the sales gets a credit. So this is the entry. And you can say when you recorded a trade receivable, it is like recognition. It is like recognition of a financial asset. You recognized a financial asset in the books of accounts when a credit sale is made. Now let's go to the next sequence of entry. So let's say a bill of exchange is drawn upon the customer. A bill of exchange is drawn upon the customer. So we do the entry, bill receivable gets a debit and the trade receivable gets a credit at this stage. So what you've done basically, you can say that you've exchanged a financial asset. I would not say that there is a derecognition of the financial assets. Derecognition basically means removal of the financial assets from the books of accounts. So when you drew a bill of exchange, it is not a removal of the trade receivable. It's like exchanging one financial asset for another financial asset. So this is basically, you can say, an exchange. And then comes the third one. Let's say this bill receivable is discounted. Let's say the bill receivable in this case gets discounted. So the entry which we learned, that was bank gets a debit. Bank gets a debit in this case, and the bill receivable gets a credit. And if there is any kind of discount, the discount in this particular case gets a credit. The discount gets a debit at this stage. So this is the entry which is done at the time of discounting the bill of exchange. Now, if you now ask me what have I done, I have given a bill receivable a credit. When I've given a bill receivable a credit, I can say this is what you've done. You've gone in for a derecognition. You've gone in for a derecognition of a financial asset, and this derecognition means removal of the financial asset from the balance sheet of the company. I hope you got the sequence correct. So first of all, a financial asset is recognized, then it is exchanged, and once the bill of exchange is discounted, it leads to the removal of bill receivable from the books of accounts. That is called derecognition. Derecognition means removal. What if I tell you today that this entry which you have done on terms of bill receivable discounting, if I tell you what if this entry is wrong? You'll maybe think, oh my God, we've learned so much of new accounting in life that which has overtaken the previous concepts in life. Whether it was in graduation, whether it was in CA Inter, Indian accounting standard has changed a lot of perception in towards thinking. And trust me, if I go with the basic fundamentals in terms of my derecognition principle, which I'm yet to explain, this entry is wrong. Discounting the bill of exchange cannot result in removal of the bill receivable from the books of accounts. So, but why? I'll tell you now the why. The standard setters realized one thing. Let me, just say something, and we'll work upon the principles later. When you got the bill of exchange discounted, what are you technically doing? You're basically giving a bill of exchange as a security to the bankers and taking money from the bankers against that asset. So that's like taking a loan. And that's like, indirectly, which I was speaking earlier in financial liability. You should rather put the entry bank gets a debit and the financial liability loan gets a credit. Why do you land up derecognizing a financial asset? And trust me, if you remove the bill receivable, what is technically happening is the bank goes up, the bill receivable goes down. It's an internal change within the asset side of the balance sheet. But if you record a liability, your liability will increase in this case. It'll also have impact in terms of, let's say, your current ratios, or let's say your debt equity ratios. So these standard setters, could understand that companies are entering into arrangements where they are basically, organizing loans. But they want to disguise the entire scenario and give the feeling to the other fellow that, in this particular case, it is removal of the asset. So they created a concept of derecognition principle. So we need to understand what are the derecognition principles with the help of which we will decide is the removal of the asset can take place or not. I'm now going to share a chart to you on the screen, not here, on the laptop screen. And we're just going to watch the chart. But I'm going to work upon the thought process today. We're going to work on more nitty gritties on that chart. I know what I'm doing in terms of derecognition with you is quite technical indeed. I 100% agree with that. But you need to be very carefully listening to me, because once you get the grip, you'll understand the importance, because this is something, which is going to involve a lot of thought processes. Let me share something on the screen to you. Okay, so I am just going to share something on the screen. Just give me a minute. So there is a wonderful chart which is given in the study material, and that is on the derecognition part. So I'm just sharing that on the screen at the moment. This is unit number 5 of the study material I'm looking at. And I'm just going to share a small little chart at this stage. Don't get worried as you look at this chart. Just have a look at this. This is in the study material. I am just going to condense it a bit so that we can, perhaps have a look at this in one go. Now, just have a look at this chart. Don't get scared as you look at this chart. Maybe you may not be able to look at this chart in a go. There might be a lot of things looking out here. So not visible. Okay, I think let me zoom it further. Then we can scroll it down. I think now it should be visible, I guess. Now, just see a few things. I'm not interested in showing you this chart in entirety right away. We're just going to look at a few things to begin with. Now, in this case, I'm reading, first of all, the circle below. I'm not reading the first one. I'm not reading consolidate all subsidiaries. I'm not reading that. You can see, first of all, in this one box, it talks about a cash flows from the asset getting expired. It talks about the cash flows getting expired. Now, please hear the chain. I'm just going to create some chain of thoughts in your mind. Derecognition involves evaluation of certain principles, and I have divided this in terms of a three-step model. I've divided this journey in terms of a three-step model. The first thing we're going to do is apply what is called a cash flow test. Then you can see that I am given further. It says transferred the right to receive the cash flows. So the cash flow test has got certain sub-tests as well. We're just looking at the chart right now. Don't get worried. Then he says the entity assumed a contractual obligations to pay the cash flows in an arrangement. I think we are looking at the word cash flows in all these three circles, oval shapes. Then he says entity transferred substantially all the risk and reward. And then we can see further, in the end, it says the entity has retained the control of the asset. Now, don't get worried. I'm first going to give you a chain of thought. Please hear me very carefully. I'm just going to first build my concept through this particular concept. Let's see. In terms of the derecognition principles, which are given for financial assets derecognition, I'm now going to give you a simple three-step model. Don't get worried on the terms. Don't get worried as what is evaluated under each step. We'll see that step by step later. So we're going to divide this entire inputs in terms of a three-step model. We're going to divide this entire inputs derecognition in terms of a three-step model. Now, first see the flow, how to think. Then we'll get deeper into one by one, each step one by one. But first, just get the art of how you need to proceed in your thought process. So right now, I am just giving you a thought process, nothing more. So don't get carried away with the facts or what does this term mean, what does that term mean. The idea is just to give you a thought process of how you need to think. Now, the first thing is the step number one. The first one is a step number one, and you've got step number 1A, you've got a step number 1B, and you've got a step number 1C, sequentially to be applied. So this step number 1, 2, C, 1, ABC is to be applied in a complete sequence altogether. In step number 1, I am going to apply what is called a cash flow test. The step number 1 is called a cash flow test. So your step number 1 is supposed to be called as a cash flow test. Now, what is a cash flow test? Don't get worried on that, but I'm just giving you that step number 1 is called a cash flow test. So in this particular case, I will put 3 questions in a sequence to myself. The question number 1A, which I'm going to put across is the cash flows expired? The first question I'm going to ask myself is the cash flows expired? If you say yes, they've expired, then you are ready to derecognize the financial asset from the books of accounts. Now, don't get worried on, sir, what is expiry? We will understand that. I'm again putting it, I'm just giving you a thought process. What is expiry and all those things? We'll see later. But you need to understand the question which I'm going to put across to myself is the cash flows expired? If you say yes, you'll derecognize the asset from the books of accounts. But if you say no, then you're going to go to the step number 1B. Then it's time to go to the step number 1B. In terms of step number 1B, we'll say, okay, are the cash flows transferred? Then we're going to see that is the cash flows transferred in this case. Now, let's not get worried on what is transferred. We'll see what is expired. We'll see what is transferred. But you're going to see the sequence that when I say the cash flows are transferred, the answer would be a yes or the answer would be a no. If you say the cash flows are transferred, you need to go to the step number 2. You need to go to the step number 2. So if you say the cash flows are transferred, I will go to the step number 2. And if you say the cash flows are not transferred, then I would say, okay, let's go to the step number 1C, sequence. Just look at the flow in which you need to think and ask questions to yourself. Is the cash flow expired? Yes, derecognize. No, go to the step number 1B. Is the cash flow transferred? Yes, step number 2. And if it is not transferred, step 1C. Step number 1C is that is it a case of PTA? That's called a pass-through arrangement. It is a case of PTA that's called a pass-through arrangement. Let's not get worried on what is a PTA, what is a pass-through arrangement. So we need to see that, okay, if the cash flows are not transferred, is it a case of a pass-through arrangement? There are certain conditions which will decide whether it is a pass-through arrangement. What are those conditions? We'll see later. Here again, if you say yes, it is a pass-through arrangement, we go to the step number 2. But if you say no, the cash flow, the pass-through, it is not a pass-through arrangement, then the financial asset needs to continue in the books of accounts. Then the financial asset needs to continue in the books of accounts. So it's as simple as that. You need to just mind your thought process like this. Is the cash flow expired? Yes, derecognize. No, 1B. Is it transferred? Yes, step number 2. No, 1C. Then 1C, is it a case of PTA pass-through arrangement? Yes, step 2. No, then you cannot derecognize. You need to continue the asset in the books of accounts. Am I clear, friends, with this thought process so far? Then I'll take you to the step number 2 and 3. Clear with the inputs in terms of the step number 1 ABC, so far so good. Just the thought process, what is to be evaluated, will be seen later. So don't get worried on that part. Okay, great. Now let's go to the step number 2. Now we go on to the step number 2. And in terms of step number 2, we are going to do what is called a risk and reward test. In step number 2, we are going to conduct what is called a risk and reward test. So there is a second principle. The first principle is called a cash flow test. And the second principle is called a risk and reward test. Now, what is a risk and reward test? We'll see later. But we will put a question, and now there are going to be two permutations and combinations. So there will be two possibilities. Rather, let me put it like this. There will be three possibilities. So there will be one of the three possibilities. So this is not a sequence. These are possibilities. Once you will evaluate the risk and reward test, then in this particular case, we will look into the possibilities. And the possibilities is the risk and reward substantially transferred? Is the risk and reward substantially transferred? Is it substantially retained? Is it substantially retained? Or we can say it is neither substantially transferred nor substantially retained. It's neither substantially transferred nor it is substantially retained. It's a mixed situation. It's a mixed situation because the word is substantially. So either it is substantially transferred or it is substantially retained, or there could be a mixed situation, neither substantially transferred nor substantially retained. How is this evaluated? We'll see later. No worry. But if you come to the conclusion that yes, it is substantially transferred, then I will derecognize the asset from the books of accounts. But if you say it is substantially retained, you cannot derecognize. The asset will continue in the books of accounts in this case. And you can make a guess that if it is neither, then we need to go to the step number 3. So step number 1, ABC sequence. Step number 2, it is possibilities, either substantially transferred or substantially retained, or it's a mixed situation, neither transferred substantially nor retained substantially. Then it's time to go to the step number 3. Let's go to the next one. The next input is the step number 3. The next input is the step number 3, which is called the control test. So this is my third principle. So you can see the standard setters were too, I would say, too tight and too stringent in terms of giving you, the inputs that whether you can derecognize an asset. Because most of the cases when derecognition will not occur, trust me, it'll create financial liabilities. The industry was creating such a, permutations and combinations, trying to create such an infrastructure where they were trying to defeat the provisions and they were trying to remove the asset instead of creating a liability. And that, as I said, has got a huge impact in terms of the debt equity ratios, in terms of the current ratios and all. So I think the companies would have manipulated the way a debt equity profile of a company looks at. So the standard setters were very, very tight in terms of deciding the principles of deciding whether derecognitions can occur or not. Now coming to the concept of control test. So here again, we're looking at possibilities. Here again, we're looking at the possibilities, and there are going to be only two possibilities in this case. Unlike three possibilities, there are only going to be two possibilities in this case. The possibility number 1 is that it is transferred, and the possibility number 2 is the control is retained. Either you have transferred the control to the other party, or the control is still with you. If you have transferred, then in this case, we will go for a derecognition. And if it continues, if it retains, now, instead of saying that the asset will continue, we'll call it as a partial derecognition. So we're going to call this as a partial derecognition. It's neither a case of complete derecognition, it's neither a case of continue, but it is a case of partial derecognition. I think something might be visible to you. Otherwise, let me also say something. You can see the concept which flows in all these three tests. One thing is very clear, and that is there is either a case of a derecognition, which is called a complete derecognition. So wherever I have written derecognition, wherever I've written derecognition, this is a case of a complete derecognition. Wherever I've written derecognition, it's a case of a complete derecognition. The second possibility is that there is a partial derecognition, and this is the only case where there is a partial derecognition, and the other cases we have said continue. So on the basis of application of these three steps, you will come to the conclusion that there are three kinds of accounting which will trigger in terms of derecognition of financial assets. Either it is a case of a complete derecognition, or it is a case of a partial derecognition, or it is a case of continuation of the financial assets. Sir, can you please connect the dots once again? This is getting heavy, more and more heavy. Good. But I think you're connected with the dots right. Did you get my thought process very clear, friends? I'll just connect the dots once again. I've just given you the inputs in terms of how to think. And I think that's very important. First, you get the inputs in terms of how you're going to think. Great. Let me just quickly connect the dots once again to you. So what you need to remember is that the removal of a financial asset from the books of accounts is called a derecognition of financial asset. So somebody tells me that put me in a layman term and tell me what is the concept of a derecognition. I would say the removal of the financial asset from the books of accounts is called a derecognition. So are there some broader principles with the help of which we will decide the removal of the financial asset? Yes. And what kind of accountings it can lead to. So I said the first one is a cash flow test applied in a sequence, step 1 ABC. The second one is a risk and reward test, which has got three possibilities. The third one is called the control test, which has got two possibilities. So your mind should be tuned. The cash flow test has got three sequence ABC. The second test, risk and reward, has got three possibilities, and the control test has got two possibilities. So we need to be clear which combination leads to which particular accounting treatment. So in the cash flow test, you first ask yourself a question: is the cash flows expired? If yes, full derecognition. If no, you go to 1B and say, are the cash flows trustworthy? If yes, then you go to step 2. You can't decide at this stage. And if no, you go to 1C. And then you need to see that is it a case of a pass-through arrangement? What is that? We'll see. But if you say yes, it is a pass-through arrangement, you go to step 2. So the only case in step 1 when you say a derecognition is when it gets expired. In the other cases, you need to go to the step number 2. You need to go to the step number 2. And if you say no, it's neither a case of PTA, then you continue the asset. So either it's a full derecognition, 1, or it's a case of continuation, that is 2. Then we come to the second test, and that is called a risk and a reward test, where you need to see how to assess the risk and reward is substantially transferred to the other party, substantially retained, or it's neither substantially transferred nor substantially retained. And therefore, these three possibilities will decide the treatment. If it is substantially transferred, it's complete derecognition. If substantially retained, you continue. And the only case we need to go to the step number 3 is when you say it's neither transferred substantially or retained. How all that assessment is done, that's what we're going to work upon. And then we said in the step number 3, you look at the control test. In terms of the control test, if you say the risk, the control is transferred to the other party, derecognition. This is derecognition, and this is complete derecognition again. But if you say it is retained, then it's not a case of continue, but it's a partial derecognition in between the two. So these three tests will decide the fate of the kind of accounting to be done. Either it'll trigger a case of complete derecognition, or a case of partial derecognition, or a case of continuation. And we need to see which cases, which kind of accounting applies, and how are these three kinds of accounting done, beautifully explained in this study material. So we'll be working upon this entire agenda on the 3-step model which I've given you. not today, of course, in the next class, where we go to deep dive in terms of all these three derecognition principles. What are they? And we'll also deep dive in terms of three different kinds of accounting treatment, how it is done. Must be feeling a bit heavy. It's okay. But what you need to do, you need to do a cumulative revisions once again. Okay, so I think let's put some questions if you've got any. It is good. That's wonderful indeed. So what is a partial derecognition? Now, this is what you're going to understand once we come to the principles of these three tests. And what is a partial derecognitions? How does it lead to a recognition removal partially of the asset and liability? That's what we're going to learn. No worries on that. So that is going to be an agenda. You'll get the answer for that once we understand the principles and the types of accounting in this case. Right, friends, I think that seems to be good. Must be feeling heavy as well. So in the next session, we'll start with our discussions on these principles with you, friends. Seems to be no further questions coming in, I guess. Mentally tired. Great, friends. So that's all for the day, friends. Thank you very much. I'm going to see you in the next session. Thank you. Bye-bye. Take care. Thank you very much. Thank you very much. Haji, thank you. Same